What's up, guys? Today in this video, we are going to talk about the differences between an IUL and whole life, and why I think IUL should never be used for infinite banking, ever. So my name's Devin Burr. If you guys don't know me, if you're new to my channel and you get value from this, subscribe and hit the bell so you get notifications when I put out new videos, and leave comments, things that you might want to know more about. That way I can serve you guys better. So first and foremost, differences between an IUL and whole life insurance. IUL meaning indexed universal life. So first thing is the lack of guarantees. In an IUL, the fees are not guaranteed. The cap rates are not guaranteed. So what does that mean? A cap rate is where they're going to put a cap on how much growth potential you can have in the policy. So let's say the market is returning 20% interest. They're not going to give you all 20%. They might cap that at 12%, let's say. But there's no guarantee that that's going to stay the same. So if the market is returning 20, let's say they cap you at 12, you get 12%, the company keeps the difference. But if the company's had some down years, they might want to make up for that difference by lowering the cap rate. So let's say they lower the cap rate to 8%. The market returns 20, they only pay you 8. They're making up for their losses. Okay, so that's one of the things. They could lower the cap rate down to who knows what, right? So that's one thing, is that there's no guarantee on cap rates. You could have that lowered at any time. The fees are not guaranteed. So the internal fees, everything that's charged, that can go up anytime. The company can say, hey, look, we had some off years. We got to make up for these differences. Let's jack these rates up, or I'm sorry, these fees up, so that we can make up for our losses. Okay, so that's one thing. Next thing is the cost of insurance. It's not guaranteed. It actually gets renewed every single year. It's called annual renewable term. What that means is that every single year on your anniversary date, you're going to have a new term insurance that's going to give you the death benefit. And what that is based on is the insurance company's net amount at risk. So let's say they've got a $1 million death benefit and you've contributed over however many years, 300 grand. They have a $700,000 amount at risk, right? Because you've only put in 300, and if you pass away, they got to pay out $1 million. So what do they do? Every single year, they look at what's the amount at risk, and then they base it on your age. Okay. As you get older, you are more expensive to insure. So literally in an IUL, every single year, your cost of insurance goes up, and the older you get, it goes up exponentially. So how does a whole life policy differ with that? Whole life is guaranteed level cost of insurance. It'll never go up. The cost of insurance is the exact same the first year and the 80th year. Doesn't matter how long you have the policy, how old you get, the cost of insurance never goes up. It stays exactly the same. And the fees, they're guaranteed 100% level. They will never go up. They're guaranteed to stay the same. Why is that important when it comes to infinite banking? You see, with infinite banking, the main thing you want to look at is control. Having control of your money and be able to put it in a place where it's not going to lose value. It'll never go down. And then you have control of it to use it elsewhere. So you have it in a place that's growing, and then you can use it elsewhere to grow it somewhere else at the same time. And that's just not possible in an IUL, because if you're putting your money into an IUL, and then with infinite banking, you're supposed to use that money right away to go pay off debt, to go make more money in real estate, to go make more money in the stock market, whatever you're looking to do. The thing is, you can lose money in an IUL. You can't lose money in a whole life insurance policy, because whole life is guaranteed to do one thing and one thing only: go up. It'll never go down, because the cost of insurance stays level and you get a guaranteed growth every single year, plus dividends if it's in a participating policy, which means mutually owned company that pays dividends. So think about this. If you have an IUL and there's a down year in the market, when that happens, the whole benefit to an IUL that agents will tell you is that there's upside potential without the downside risk. So you could get up to 12% growth, up to 14% growth, up to 10% growth, whatever the cap rate is. Remember, that can be lower, but you can get up to that amount, but then there's a 0% floor, so you can't lose money. However, let's say that 0% floor hits. There's a down year in the market and you don't earn any kind of value on your policy because there is 0% earned. You see, what happens is you have your cost of insurance, if it's through the roof because you're older, if your fees have gone up, all these things that you don't have control over in your policy, if they've gone up through the roof and you have no growth, how's it going to get paid? It gets paid through your cash value. So your cash value will go down. Here's the thing. If you're using infinite banking, you're not going to have a bunch of cash value. That money should be out working for you. So if you don't have any money in your policy, if you have no cash value because it's out working for you and there's down year in the market, your fees and costs have to be paid. How? You have to put more money into the policy. You have the ability to lose money in an IUL. Whole life, never, ever can that happen. So that's really a big difference right there with an IUL and whole life. Now, another thing that I think this should be taken into consideration is whole life has been around for several hundred years. It has stood the test of time. The companies that I write policies with have been in business for, one of them is 160 years. And that company has been profitable every single year, meaning even when the economy is really bad, Great Depression, World War I, World War II, the meltdown of '08, COVID, you name it, these companies are profitable. That means since they are a mutually owned company, they're paying dividends. So they're giving you a guaranteed growth. It'll never go lower than that guaranteed growth, which is 3.25%, tax-free. You're also getting dividends by participating in the company's profitability. And if they're always profitable, you're gonna just keep getting more and more cash value. So they've stood the test of time. An IUL has not stood the test of time. IULs came about mid-2000s, so 2005, 2006, somewhere in there. So they really haven't stood the test of time. If you think about what we've been in the last 13 years or so, one of the biggest bull runs ever in the market. And IULs, even though we've been in that huge bull run, you would think because of that, they've gotten all this upside growth, IULs still haven't outperformed what they were illustrated at when they were taken out. That's crazy. Is agents are actually selling these as the best thing since sliced bread. You can't lose money. You can get so much more growth than a whole life insurance policy. And it's just not accurate. The fact of the matter is, if there is an agent out there telling you that an IUL should be used for infinite banking, what they are doing is they are trying to sell you on something that pays them more commission. IULs pay a ton of commission, but they should never be used for infinite banking. The person trying to sell you that doesn't understand how infinite banking works. Infinite banking is all about control with zero risk. IULs have risk. Whole life insurance policy, if it's structured correctly, zero risk. Your money only goes up. It never goes down. So again, guys, IULs should never be used for infinite banking. And I'd love in the comments if somebody feels otherwise. I'd love to go ahead and educate you a little more on why it just doesn't make sense, guys. There's surrender fees that are crazy high with IULs. Why do you think the surrender fees are so high? It's because the agent makes a ton of commission. The insurance company needs to make up for all that ground by not giving you access to your cash value early on. So they give huge surrender fees for 10 to 15 years. Now, I have whole life insurance policies that I've structured for myself and also for my clients that are efficient, meaning you put money in and you can instantly borrow out more than you just put in by year 2. 2 years in, easy math. Let's say you put in $10,000 into that policy. In year 2, you can borrow out $11,000. Your policy is efficient. That means every single year from your second year, or your third year, your fourth year, however your policy is structured, you have access to more than you're putting in. And that difference, like the next year it could be 13,000 you can borrow out. Next year, 16,000. Next year, 20,000. The difference from what you put in and what you can borrow out does one thing and one thing only: goes up. And that again is because of the very fundamental thing I'd said in the first part of this video. With a whole life insurance policy, you get guaranteed level cost, level fees. They'll never go up. However, your growth never stops. You get guaranteed 3.25% growth. It'll never be less than that. It could be more because you're going to get dividends if it's a participating company. So again, costs never go up, fees never go up, but your compound interest, the amount of money you earn, only goes up. So you're just having access to more and more and more money. The more you put in, the more you have access to, and it just perpetuates on itself. It's like a never-ending tailwind. Like if you think when you're in a plane, if you get a tailwind, you can go so much faster, but with less energy, right? With less effort. However, that same plane, if you put a headwind into it, it has to work so much harder to go the same speed. It's the same kind of thing, guys. Bottom line is an IUL should never be used for infinite banking. An IUL should be used really for one thing and one thing only. In my opinion, it should kind of be treated like a qualified retirement program, something that you don't plan on touching. Think of like a 401k, an IRA, things that you're putting money into knowing you're not going to touch it until you're 60 years old or whatnot. Because if you use an IUL, if you start using the money, if you start taking policy loans, what you're doing is you're putting stress on that policy. And the more you do that, the more at risk the company is, because they're going to have more net at risk, like I was telling you. So every single year when you renew your policy on the annual renewable term, your cost of insurance is just going to keep going up. So the more you use an IUL, the more risk you have of hired insurance, hired fees. It just will never work, guys. It has not stood the test of time, and it will not stand the test of time. So I hope you guys got a ton of value from this. If you are not subscribed to my channel already, make sure you do that. Go ahead and subscribe, hit the bell so you guys can get notified when I put out these videos. I've been asked about this kind of video so often, so I wanted to make sure I put it out for you guys. So I love you guys. Thank you so much for following my channel, and please share this video with someone who can get value from it. So I love you guys. Until next time, peace.